All right, guys, so jumping into this video, I wanted to talk about the lost decade. So the lost decade is a period from the stock market from 1999 to 2009. This is a period when the stock market as a whole did not make money. So from 1999 to 2009, so in 1999, let's say the market was at $200. Well, 10 years later, at 2009, the stock market was also at $200. And so it didn't increase in value. And so that's why it's called the lost decade, right? Because investors, if you would have invested your money in 1999, through 10 years of holding in the stock market, you would have made some money probably through dividends, but you wouldn't have made money through stock appreciation or through the stock market increasing in value. And the stock market lost decade mainly pertains to large U.S. stocks. So U.S. companies that are in the S&P 500, which is mainly where you see your large cap stocks. For instance, you see those FANG stocks, which is FAANG, Facebook, Amazon, Apple, Netflix, Google. Now we can throw in there companies like we can say Disney, we can say Best Buy, we can say Walmart, Coca-Cola. Those companies, large U.S. companies, through that period made no money. And so if we're going to see, we need to understand why did this happen, right? Because you don't want to be investing for 10 years and end up making no money. That is not a situation most people want to be in, and that's something that I want to help you protect against. So let's understand why exactly this happened. So the lost decade pertains to large U.S. stocks only. And so what does that mean? Okay, so the lost decade, if we look over that 10-year period, refers to the S&P 500, and the S&P 500 only tracks the top 500 stocks. And those top 500 stocks, actually 505, I think, but those stocks are large U.S. companies, right? I guess Tesla's now in there, but it wasn't in there back in the 1999s. It wasn't around. But what we're seeing is that the S&P 500 made no money, but the small cap stocks, mid cap stocks, those companies performed really well. They actually made money. Now, it wasn't like insanely well compared to the market, but it still at least made some money over that 10-year period. And so when we're looking at large U.S. stocks, there's two ways to combat the lost decade, aka there's two ways to ensure you don't have a lost decade of yourself, or to ensure that it doesn't happen again, because it's possible when you're tracking large U.S. stocks through the S&P 500. And we're going to talk about the first way to solve that, and that is through diversification, right? If you're only invested in the S&P 500, yes, you automatically have diversification, but your diversification is across large U.S. stocks. And so what does that mean? You're looking at a home U.S. currency. You're looking at companies mainly based out of the U.S., and you're looking at companies with a market value roughly above 1 trillion, well, not 1 trillion, like 1 billion, and you're seeing companies on that scale make no money. And so if you want to diversify, you not only want to buy SPY, which is diversified in itself, but you also want to look to other stocks. So we can see that we have small and mid cap and large. There's a bunch of different stocks that you can look into, but there's also a bunch of other alternatives. So for instance, if we look at the lost decade, the U.S. large, which is mainly the S&P 500, made no money. The U.S. mid went up about 80% over those 10 years, which is roughly about an 8% return each year. The U.S. small went up around 61%. International emerging markets, other countries in their emerging market went up 172%. Not only that, gold went up 257% over that 10-year period. So what does that show? It shows that the S&P 500 is great, but if you want to protect against the lost decade happening to you, if you want to protect against being only in large U.S. stocks, then it's okay to diversify into other sectors, other countries, and other forms of investments, right? Like stocks. You can now invest into currencies, into commodities, into bonds. Whatever you want to invest in, you can do that as well, and it helps offset that. So what does that mean? Let's say if you buy gold because it went up 257% to help make some money if the lost decade were to happen again. Well, gold is an insurance. So for more than half the time you're holding gold, it's not going to make you money. It's only going to make you money when the stock market is underperforming, because that's what insurance does. So when you diversify, you sacrifice greater returns for a decrease in risk. So you're going to decrease the amount of risk or money you can lose, but you're also going to decrease the amount of money that you can make. And so diversification is great for that reason, where it protects you, but at the same time, you can't make as much money. This is why Warren Buffett says a great example is that diversification is for idiots, right? If you don't know what you're doing in the market, then you should diversify, because it's going to protect you, and you're going to overall, in the long run, if you don't know what you're doing and you're just picking stocks, it's going to be better to diversify than not, because that's just how a beginner investor works. But there's a second option, which is trend following, understanding the trends of the market. So for instance, when a market is going up, you can buy and make money. When a market is going down, you can sell and make the inverse and make money on the way down. So if you're using a trend following technique, for instance, like the trending band indicator that the Impeccable Stock software uses, you can see here that it goes up in value. So for instance, the SPY during this lost decade went up, and then down, and that's how it leveled out, right? So it went up some, it went down some, it went up some, and then went down some, right? Up from the excitement from the 2000 dot-com era, down because of the 2000 to 2003 crash from that dot-com bubble, and then slowly starting to rise again and recover from that tech bubble. And so you could have invested on the way up using trend following techniques that have been proven over decades and make money on the way up during the tech com, and then sell when you see that it's starting to reverse here. Make money on the way down using either options puts or inverse ETFs like SCS to make money on the way down. See when it's going to start to recover, buy the S&P 500 again and trend it on the way up. And you could make roughly a 50 to 80, even 100% returns while the market made nothing. And so there's two different ways to offset the lost decade that you need to remember. One, either diversify in stocks that aren't just solely US large, or use a strategy like trend following that can help you follow the biggest trends in the market so that you're not caught riding the up and down waves, but you're buying a stock when it goes up. All right, guys, if you want to learn more about how to know where exactly to buy any stock, for instance, you were watching this video or listening to this podcast, and you're like, wow, if I could follow the trends of SPY, aka knowing and having a clear direction of where the market is going and why, then check out the Impeccable Stock software, 14-day free trial linked below. It's going to show you the exact game plan for every stock, show you where to buy, where to set your stop loss, and why. I also send out weekly stock market breakdowns, so you can see what my thoughts are on the market, where it's projected to go, and why, as well as the top stocks for that week. All right, guys, thank you so much for watching. Join me, smash that thumbs up button, smash that subscribe button, and watch me next week as I come out with other amazing videos. All right, guys, thank you so much for watching. See you next week.